morning, everybody. This is Live Trading Talk with Patrick MontesDeOca for April 11th, 2022. Russia appoints a notorious general to oversee Ukraine war amid setbacks, U.S. says. With Russia planning a major offensive attack, this could quickly affect commodity prices, especially palladium prices, wheat prices, grain prices, natural gas, crude oil. Russia is the world's largest mining exporter of the white metal, palladium. Russia is rearranging basically their strategies with a lot of movement to the East Front, race on the rearmed East Front that may decide Ukraine's war. So it appears that Russia is preparing a massive attack from the Eastern Front. There is about an 8-mile long, once again, convoy moving towards the Eastern Front. So it seems that we are preparing and building up for a potential major attack by Russia again. Just to summarize a couple of points here, Ukraine calls on civilians in the Eastern Front region of Luhansk to flee immediately. Its governor, Serhiy Gaidal, warns that Russia is amassing forces for an offensive there. Russia is stepping up their offensive in eastern Ukraine after withdrawing from the north. It is also believed to have reorganized its military leadership in Ukraine, with General Alexander Dvornikov given overall charge. Western officials say the general has extensive experience of Russian operations in Russia. In Syria, UK PM Boris Johnson visited Ukraine on Saturday and held a meeting with President Zelensky in Kyiv. So we continue to see a lot of pressure coming in from this geopolitical crisis that we have. And it seems that it's building up momentum for another aggressive move here taking place in the very short period, over the next couple of weeks possibly, or sooner. This is coming into an economic situation here that basically is a bit of, I would say, conflicting data, because during this time, Fed's Bernard sees balance sheet reduction as soon as and at a rapid pace. In terms of the economics, the 10-year yield rises to a 3-year high as the Fed plans a speedier policy tightening. So we have a situation where we have runaway inflation. Inflation is running at about 7.5%. And we're looking at interest rates at about 250, 275. So we still are down about 5 basis points, and in order for the economy basically to meet the criteria, the financial criteria standards required by the IMF, the International Monetary Fund, is that it should keep rates a point higher above inflation. So if we're running inflation roughly at 7.5%, 8%, rates, interest rates, should be at 9.5%. So this is the dilemma that we have right now during a potential short supply or squeeze on supplies coming in from the region. We're dealing with an accelerated level of inflation, and interest rates are going through the roof. It is a really mixed combination of signals that we have here, but let's come back here and try to put this into perspective as we are taking, for example, a look at the possibility that as a consequence of this tremendous crisis, we are seeing about 25 to 30% of wheat production disappearing from that region. The Ukraine, Russia are major producers in metals, grains. They produce about 28% of the commodities to the world. Russia is the largest palladium producer, and so we have a potential dilemma that is building here that I think we need to pay close attention to, and that is essentially that the Ukraine corn wheat exports will plummet further, U.S. says. U.S. issues forecast as war raises grain fertilizer prices. Wheat, corn, and soybeans futures leap higher in Chicago. The grain prices stand to explode. And we could be looking at $15 wheat real soon. Corn and soybeans are also being affected tremendously, and corn traded as high as $7.82. I would not be surprised to see corn trade over $10 a bushel. We're looking at soybeans traded $17.59. I would not be surprised at all if we see $20 beans traded. Crude oil, it's down about 388, down to 94.37 here. It's at a major area of support, and you want to be looking at this market correcting about 50% Fibonacci retracement for a resumption of the uptrend, particularly if we run into another confrontation in the Black Sea, which is pretty eminent that it's building. It's building the possibility that that's where we're going to see the next confrontation, and supplies are going to be shut down to the Western economies. So what I see here is that this inflation factor is not going to go away anytime soon. I think we're looking at a potential spike in the very near future. And when we take a look at gold trading 1953.50 up 790, we saw a high today of 1974.60. And this is the ceiling that we're looking at in gold before an acceleration from these levels, potentially all the way up to 2150, which is the upper end of this long-term uptrend channel that you see the gold market is building. So there is no question that the situation, the cut in production from that region is affecting commodity prices. And I believe that we're looking at potentially record-breaking prices coming up here in the summertime in grains, metals, energy prices, pretty much across the board. One of the interesting things that is developing here is that the London Bullion Metals Exchange has experienced a decline of about 28% of the supply of gold from that region. That is a major shock to the physical market in gold and silver, and it could once again begin to put a squeeze in the metal. And this is pretty much what we're anticipating here, that the supply shortage coming in from the region has not yet been factored into the prices. It has, for grains initially, obviously, factored in some of these anticipated shortages prior to the situation that is unfolding. But if we do get another confrontation developing in the Black Sea, it's going to be impossible to get any kind of commodity out of that area. And we may see, again, a squeeze in supplies. This goes for gold, this goes for palladium, this goes for silver, and we could potentially, in around the August period, July-August period, experience probably the most highest level that we have seen in inflation in the last 50 years, forcing the Feds basically to either change course or come up with some magic money policy, creative ideas that essentially will change us from the possibility that this can only lead to one thing and one thing only, and that is a deep recession. Because the Feds are going to have no choice but to raise interest rates sharply. And there is a talk of the Feds as we come into this next meeting that they will raise it by a half a point. The market already has discounted at least a full point increase. If you look at what's been happening here, actually since June of last year, when the Feds basically initiated the talks that they were contemplating raising rates and tapering. And that was the top of the market basically at that point, and we saw a massive correction in commodity prices, in gold prices in particular, digital prices, digital assets. And the only thing that they have done is raised a quarter point in the last meeting. And yet the market itself has discounted at least a full point. So that is a 4/4 point increase, or 2/2 point increase, or 1 full point shock and awe that could happen in order to control this accelerated level of inflation that we have. The problem is that it is not the feds that need to control this inflation factor. It is supply. It's the old basic economic law of supply and demand, Economics 101. If there is demand, as we have record demand coming out of the pandemic, people are anxious to go out and spend, but there are no supplies available. In some stores you go, you have empty shelves. China is recommending their people to stack up on food. We're beginning to see panic setting in food supplies around the world. And so the next black swan, as we see this developing here, is going to be a shortage of food supplies, a shortage of commodities, a shortage of metals, a shortage of just about everything across the board. So what do we do? You hear a lot of people saying out there, prepare, but how do you prepare? Well, one of the things that obviously we're doing here is we're getting long. We're long the metals. We're long silver. Even though we are trading the market short-term for short-term profits here, we're long gold, silver. We're long wheat. We bought some wheat this morning. And we took some really good trades out short term. We profited about 17,000 this morning on some overnight swing trades that we have in gold and silver. And we are building, a position in these areas that I believe are going to be affected by this Russia shortage that is developing here. Let's take a look at the markets that we're trading here and see pretty much where they are. We've gotten a little bit of a pullback here in gold from after completing the targets of 1963, the weekly, the daily 1966, and the sell-to level on the weekly was 1976. We only got up to about 1974.40. We have reverted back down and activated a short trigger with a target of 1944. Now, these are short-term trades that has not changed or affect the fundamental picture that we're looking at. As we build a position long-term because of these fundamentals, the market offers the opportunity for us to take advantage of it short-term. And we use standard deviation and mean reversion trading to identify the extreme levels of speculation for that day. In particular, gold here, for example, we're looking at the area in red to tell us as we come in here that we can expect sellers to come into the market. This is the extreme level above standard deviation of the mean of 1940 on a weekly basis. It also is the standard deviation extreme level above the mean of the daily 2 standard and 3 standard deviation. So we took some profits here this morning, and we are waiting to buy corrections. as the market gives us the opportunity to come down to the extreme below the mean, maybe even to the buy one, buy two levels that you see, where the AI tells us that this would be the highest probability area for us to buy the market. There will be fluctuations, there will be volatility fluctuations, and we use those fluctuations short term to advise our traders here in our private trading room, basically, to take advantage of it for those that are interested in day trading, swing trading, or position trading. Silver's down. It's actually 25.14 up 31, but it's down from the high that we saw here early of 25.60. 25.64 was the weekly target. 25.37 was the sell one level. And it coincided with the daily as well, as you can see. So it also recommended to unload some of the profits up here if you bought it down here last Friday, as we recommended to hold on to it, to hold on to our long positions. So these are great markets to trade and take out, 20, 30, 40 cents in trading a swing or a position trade and allow you to continue to accumulate for the long term. Bitcoin has come down to the weekly buy one level of 40,950 and has activated a weekly buy trigger from here. We've come down from the extreme above the daily mean of 44,000, around the 44,090. And we are in a blue zone. We are in an area that is recommending to accumulate supplies. So hold on to your long-term trades as we have approached an extreme level below the mean on Bitcoin. Hecla traded as high as 709, 714 today, accomplishing the weekly target, the sell one level of 709. A lot of movement. We're beginning to get a lot of movement in that area, in that stock. Hecla is the largest silver producer in the United States. The wheat is reverting back up here. I'm sorry, the wheat is breaking out as well, 1089. So continue to diversify yourself into what I believe is an incredible opportunity into commodities at this point. Grains, wheat, corn, soybeans. or choose one of those markets that you're comfortable with. There's an incredible amount of opportunities across the board, basically in commodities, from metals to commodities, grains to energy prices. We're focusing on gold, silver, Bitcoin, and now we're adding grains to the basket. We want to make sure that we are at least hedging ourselves in this inflationary cycle that seems to be moving and looking for higher highs. Let's see what the Feds do here on this meeting and how much tapering they're going to do. It is contrary to what they should be doing. And the danger is that they can change policy by reverting everything back up here. And if they see that we are moving into a danger of a deep recession here, we could be looking at the same situation as 2019 when they reverted their policies and the markets just exploded to the upside. And interest rates went down to zero. It's a different situation right now. We got a record debt, and according to the IMF, interest rates should be at 9%. What is that going to do to a $30 trillion debt? What is that going to do to the stock market? What is that going to do to the world economy? These are serious subjects that we need to focus on, but great crisis situation building, and that creates an opportunity, incredible opportunities. Stay put, my friends, and take care here. Be careful. Don't over leverage yourselves here, and I'll talk to you next time. Have a great trading week.